Many Kenyans are quickly embracing digital money lending as a way of acquiring credit away from the traditional financial institutions. But what are the pros and cons of the digital cash? 42-year-old Francis Kimani, a vegetable vendor at Ngara Market for over 17 years, is a beneficiary of mobile money lending. Kimani, like many other small business owners in the country, has encountered hurdles in the past when it comes to financing business. But the coming of mobile loans into the market, he says, has made access to capital easy.
Zamani kuforo loan kwa banki ilikuwa shida sana. Lakini sasa hii kwa mkulima mdogo mdogo amefikiwa kupata loan kwa simu kwa njia rahisi sana, kwa sababu bereni sisi ukienda kwa apply loan unaitishwa guarantors. Kuja na garanta, kuja na ule mtu akaunti yake ni mzuri. Kwa simu hakuna maswali kama hiyo.
Tom Wafula, who is employed as a boda rider, also acknowledges the importance of mobile loans.
Kuna wakati zingine biashara inaweza kuwa chini na una mahitaji ya pesa. Unakopa ukijua probably next week nitapata na nitalipa. Na inanisaidia for that emergency, alafu within a short period of time na repay back.
However, there are those who have had negative experiences. Like the traditional loans, if not used properly, digital loans can bring financial stress. Above all, defaulting can bring further woes, and some users do not like the manner in which they are pursued by lenders.
Yani tuseme uko na loan na msesi, ndio? But sasa details zako, yani wanashare na kila mtu. Edua lipangi loan, unaona?
One of the risks is misuse of this credit. The second risk is about over-indebtedness. This technology is giving us easy access and exposing us to the risk of over-indebtedness.
Bank loans are offered by deposit-taking institutions. When you say deposit-taking institutions, these are institutions that are taking money from the public, and they pay them very little return for their deposits, and they use that money to lend. Mobile loans, on the other hand, are short-term loans, and they are little amount of loans, and you are mostly lending to high-risk borrowers, and the verification for these customers is done on mobile. You have no face-to-face interaction with this customer. And the verification is actually done through algorithms on the mobile platform itself. So it has no face-to-face. And therefore the risk to the lenders is quite high.
Indeed, digital loan lending, more so the use of mobile phone technology, is slowly and steadily redefining the financial landscape in Kenya.
What we have done is to provide access to them in a way that is easy and as user-friendly and without the intimidations that they have to go through when they have to get a typical bank loan.
Definitely digital credit, since we launched 5 years ago, has now grown at a tremendous speed. When we first came in, it essentially was Mshwari had come in first, swiftly followed by Tala. But now when you look at it, there are over 45, actually almost 47 digital lenders.
The exponential growth in mobile money lending is because there is demand.
As long as that gap is there and there is that unmet demand, Kenyans will always find alternatives in terms of going to those unregulated providers which cannot be met by the regulated providers.
The question is, do borrowers of digital loans understand the do's and don'ts, or the pros and cons of the loans, as well as the terms and conditions of the loans they are getting into?
We want every person who's a member of the Digital Lenders Association to be, upfront with the fees from the very beginning. The other thing is what kind of data they are taking. We also want that to be, fair, honest. Tell the user, why are you taking M-Pesa statements, for example, so that the user understands the importance of these kinds of data and why they're giving it to us. And then the third thing is to make sure that the user is getting the right kind of product.
While some see the growing mobile lending sector as a big boost to socioeconomic development, the Central Bank of Kenya is warning that not all is well.
Self-regulation, in my view, is what importance is to self-importance. I think we need to think a little about that, meaning there's no such place for self-regulation.
But industry players insist that digital loans are not necessarily a bad thing. It all depends on the usage.
We know that this particular sector is not formally regulated. In other words, we don't have a statutory regulator. However, we feel that we can take on the responsibility to enforce the standards, minimum standards, so that we have a professional industry which caters especially for the consumer, but more so for the broader society and for all stakeholders involved.
According to the Bankers Association of Kenya, regulation is important in order to protect the consumer besides enhancing awareness.
If it's under a regulator, some of those consumer protection issues will enforce transparency where the lender is obligated to disclose some minimum information. For example, the price must be disclosed fully to the point where you're saying it is 10% per month paid upfront or at the end, whichever, but it needs to be disclosed. So you don't take 10% and you leave it hanging in the mind of the consumer, so the consumer thinks it's per annum, because that's a normal pricing methodology. And yet you actually meant per access.